Hey everyone, welcome back to the Magic Market where we bring a little enchantment into financial insights. Today we're looking ahead at what the next 5 years could hold for Disney stock. Will it be a magical ride to new highs, or are there challenges ahead that investors need to watch out for? From streaming growth to theme park expansions, and even the risks that could impact Disney's financial future, we're breaking it all down. Let's get into it. Predicting the future of any stock is never an exact science, but by analyzing key trends, industry shifts, and Disney's strategic moves, we can get a clearer picture of what may lie ahead. Disney operates in multiple industries: streaming, film, theme parks, and television, all of which influence its stock performance. Over the next 5 years, some major factors will shape Disney's trajectory, including the long-term profitability of Disney+, the strength of its theme park business, the evolution of its studio and media networks, and the impact of macroeconomic factors like inflation and consumer spending. To give you the full picture, we'll cover both the bullish and bearish cases for Disney stock, analyzing what could drive it higher, and what could hold it back. Let's start with the reasons why Disney stock could perform well in the next 5 years. Disney Plus has been one of the company's most important growth drivers since its launch in 2019. With 146 million subscribers, it's a major player in the streaming space alongside Netflix and Amazon Prime. But the real question isn't just about subscriber growth, it's about profitability. Disney has set a goal to make its streaming division profitable by the end of 2024. If it succeeds, it could significantly boost investor confidence. Key strategies Disney is implementing: ad-supported tiers. Similar to Netflix, Disney Plus now offers an ad-supported plan to attract budget-conscious users while generating ad revenue. Pricing adjustments. Disney has been raising subscription prices to improve margins. Cost cutting. The company is focusing on reducing content spending and improving efficiency in production. If these initiatives succeed, Disney's streaming segment could shift from being a loss-making division to a strong revenue generator, helping to drive long-term stock growth. Disney's theme parks remain one of its most profitable divisions. With a $7.8 billion revenue last quarter, this segment has shown resilience even in uncertain economic conditions. Over the next 5 years, Disney is investing $60 billion in theme park expansions, new attractions, and cruise line growth. This could fuel even higher guest spending and attendance. Key developments include the expansion of Disneyland and Disney World with new lands and experiences, more international park investments, particularly in Asia, new cruise ships to capitalize on the growing demand for Disney vacations. If park revenues continue to rise, it could provide a stable foundation for Disney's overall financial health. One of Disney's biggest strengths is its intellectual property. Few companies can match its portfolio of globally recognized brands, including Marvel, Star Wars, Pixar, and classic Disney characters. New blockbuster films, streaming series, and theme park tie-ins keep these franchises relevant. Disney's ability to monetize its IP through multiple revenue streams, merchandising, box office sales, theme park attractions, and streaming content, makes it a long-term growth driver. With the potential for more billion-dollar box office hits and new streaming content, Disney's brand strength remains a reason for optimism. While there's plenty to be optimistic about, investors should also be aware of the potential risks that could limit Disney's growth in the next 5 years. Yes, Disney Plus is a major player in the streaming wars, but competition is fierce. Netflix, Amazon Prime, and Max all compete for the same subscribers, and profitability remains a challenge. Potential risks include subscriber churn. As Disney raises prices, some users may cancel their subscriptions. Content costs. High production expenses for major franchises could limit profit margins. Ad revenue uncertainty. The success of Disney's ad-supported tier remains unproven at scale. If Disney struggles to turn streaming profitable, it could weigh on the stock's long-term growth. Disney's traditional media networks, ABC, ESPN, and Disney Channel, still generate billions in revenue, but cord-cutting is accelerating. As more consumers move to streaming, Disney's cable business faces declining ad revenue and lower subscription fees. ESPN, in particular, is at risk as sports rights costs continue to rise. If Disney fails to transition its media assets effectively into streaming, it could face continued revenue declines in this segment. Macroeconomic conditions could also impact Disney's business. If inflation remains high, consumers may cut back on discretionary spending, affecting theme park attendance and Disney Plus subscriptions. A recession could lower advertising revenue and box office sales. Rising interest rates make borrowing more expensive, impacting Disney's ability to invest in growth. Economic downturns could put pressure on Disney's stock price, at least in the short term. So what's the verdict? Disney's future looks like a high-risk, high-reward opportunity for investors. If Disney successfully turns streaming profitable, expands its theme parks and leverages its franchise power, the stock could see significant gains. However, competition, media decline, and economic risks are factors investors should monitor closely. Price projections vary, but some analysts believe Disney stock could trade between $140 and $180 per share in the next 5 years, assuming its business transitions successfully. Ultimately, Disney's stock is a long-term play. If you believe in its brand strength and ability to adapt, it could be a solid investment. But if you're wary of short-term volatility, caution may be warranted. That's our 5-year forecast for Disney stock. Do you think Disney will be a winner over the next 5 years, or are there too many risks? Let us know in the comments. Be sure to like and subscribe for more financial insights, and as always, thanks for watching The Magic Market.